All right, folks. Hopefully, some, if not all of you, are starting to watch this live stream. I'm just making sure that it's going out on my accounts as well as Mike Silva's here. This should be a good conversation with a guy who's a pretty good trader. He's figured out money, as I like to say. And I've not gotten to know Mike over the last, 2 years now. Mike, I think, is sort of the time frame. Mike had me on his YouTube channel, which has been growing substantially. I've interviewed him on Spaces. Now we're doing a face-to-face where I'm interviewing him. I can see all of your comments, which means if any of you want to ask questions during this live stream, don't hesitate to put it in the comments on X, on YouTube. I'm happy to bring those up. This will be an edited podcast under Lead Lag Live on all of your favorite platforms. As always, Apple, YouTube, Spotify, please keep that momentum that I'm trying to build going by supporting the show. And hopefully we'll have a good conversation here around how the hell do you trade through this volatility. So with all that said, my name is Michael Guyette, publisher of the Lead Lag Report. Joining me for the rough hour is Mr. Mike Silva. Mike, I know a lot of people are fans, viewers on your YouTube channel that are watching this live, but introduce yourself to those who are not familiar with you. Who are you? What's your background? What have you done throughout your career? What are you doing currently?
Yeah, well, thanks for having me on, Mike. I appreciate it. I've been in the markets for roughly I'd say around 15 years, but more specifically in the last 10 years, it's been getting a little bit more serious. Prior to that, I worked in the communication space for the bulk of my adult life. I'm 36 years old now, and I've been doing that since probably close to around 18 up until the last, just a few years ago where I decided to do this full time. YouTube is what most people know me for. I run a stock market brief show there under Figuring Out Money. And what I like to do is I like to look at various things through the lens of technical and intramarket analysis to get a good idea as to where the market may be going. And I heavily focus not necessarily on, hey, look at this, I'm trading. I focus heavily on the risk management side of things.
Which kind of mattered the last 3 trading days. Although, as you and I both know, risk happens fast. I want to get your thoughts, your reaction to this sudden, seemingly overnight spike that happened in the VIX. How did you think through it? How did you trade through it the last several days, if at all? Because that's the other thing about risk management. Sometimes you don't want to trade through it. Let's talk about just some of the reactions and things that you've done.
So for the last 4 days, I've been out on vacation. And there's this funny...
Perfect timing. Oh, my goodness. That's great.
There's this funny thing that's been going around in my community that whenever I go on vacation, watch out, right? I don't know why it's that way. And I thought it was over, but go figure. But there were things leading up to what we just recently saw. More specifically, you can probably talk about this in a little bit more intricacy and more detail than I could when we're looking at what happened over in Japan. However, there were things that were leading up to this that various divergences, various correlations that were breaking, and just random little tiny things here and there that make you kind of go, what's something's a little off here. Maybe I should start to pull back. And when it comes to getting very, very specific as far as understanding when the market conditions can potentially change, there are some tools that I like to utilize. And the tools that I like to use is gamma levels. So there's something called the gamma flip line. And when we're above a gamma flip line, which is the conditions of the market that I prefer, I'm a swing trader, right? So I'm holding anywhere from, could be 1 day, could be 3 days, could be up to 3 months. I don't typically hold over into earnings. But what has happened in recent, before all this drama unfolded, is we went into a negative gamma regime, right? We fell under the gamma flip line. And what happens in those environments is you get selling into selling, you get buying into buying, you get a lot more volatility in the markets. You can look at the history of gamma. If you probably can find a chart here, but you can see that periods of time when we're in negative gamma or under the flip line, volatility increases. It's very common to do so. And when you know that by adjusting your portfolio or laying off the gas, or maybe your new positions that you go into could be smaller in size, because there's typically more whipsaws, more fake outs, more shakeouts, higher moves to the down, stronger moves to the downside, stronger moves to the upside, et cetera.
So I like that point about divergences, because I think if you are attentive enough, you can see the whites of the eyes of a regime change that could be coming, right? And usually those regime changes are broadly around volatility. The The issue, I think, and I want to hear your thoughts on this, from my perspective, is that people don't seem to appreciate volatility is volatile. Okay? And what I mean by that is markets go down heavy, everyone gets ultra bearish, and then a day or two afterwards, it's the exact opposite, right? Then suddenly volatility gets squashed and markets rally substantially. Is it better to just step aside when you're in a higher volatility state, or is it true that that old adage that traders love volatility? Because I think it's kind of a love-hate relationship.
I mean, I guess it depends on the individual, right? A lot of people want to catch every move. I was like that. I'll admit, I was looking for short positions all the time. I was looking for long positions. I was, running kind of long short book. I still am to an extent, but I will say this through my experience and what I've learned, so there's different ways you can approach the market, right? You can day trade, you can swing trade, you can invest, right? There's 3 different ways, and you can be bearish and bullish on different timeframes in all of these. So when it comes to like heavier volatility, from what I've noticed, day traders typically like it, right? Because you could get more intraday swings. Swing traders, they like it to an extent, but you typically get a lot more whipsaws and so forth. And then if you're looking in the investing bucket where you get huge spikes in volatility and the S&P 500 could be down 10, 15, maybe even 20%, investors look at that and like, yeah, I'm going to add to this, right? Because I'm in here for 30 years, or whatever the case may be. So it's really your timeline, it's your approach, it's whatever bucket that you're kind of in within that. And me personally, I when it comes to like shorting, I've changed my strategy quite a bit. 2 years ago, I used to like trading options, directionally, which I don't do that anymore. I had some great wins. I had some losses. It just feels like it didn't go anywhere for me. And I know with the whole rise in zero dates and all these YOLO options, right? People have been going a little crazy. At least that's what it looks like, from my perspective when I look out. But options are a risk management tool. So if you are utilizing them properly, it's a great tool. I just sticks to what I'm good at. And I like to make money from the long side. And I like to take my foot off the gas and protect myself when there's downside risk.
I want to show a post that you put on X, which I think is very good context, which looks at the VIX spikes and what those VIX spikes coincided with. I think this is very actually well done on the labeling end. This was very sudden, this VIX spike. Actually shocking to a lot of people. Not overly shocking to me, only from the standpoint that I, as you know, thought that the conditions were always there. I didn't know exactly when. Right. Yeah. And which is always the tricky thing. It's like you can have a thesis, but I go back to path matters more than prediction. So if you miss it by a few days, even though your thesis is right, it's not going to help your portfolio. But when I look at this chart, I wonder if the question is that spike over and done with, or is it just the beginning? Because we've clearly seen the VIX and volatility can go higher. And we've also seen that around these kind of levels, it can get squashed. So how do you think through volatility going forward here, independent of what's going on with Japan?
I wish I had a clear answer for you, but I feel like anybody with a very certain answer or is acting in any terms of certainty right here could be gravely mistaken if they aren't willing to change and adapt when things adjust. We closed over, what did we close over? Like in the over 35, right? And it's very rare to do that. Just looking back to where we were, right? The VIX hasn't been around past that area, I don't think, right? Back in the 1987 crash, I don't think VIX was even part of the structure here. But going back to 1990, right? I have some notes like Iraq's invasion of Kuwait, right? In the 90s, 1997, 1998, right? Russian and Asian currency crisis. We had the dot-com bubble, the long-term capital management, financial crisis, QE2, all this stuff. And today, or just the other day, we're down minusculely in the S&P 500 for the most part. And we just had a spike over 35. Even higher really, but we closed over 35. And the most recent time to that was when we were down 25%. And that was coming around the bear market of 2022. So yeah, for me personally, when I see this stuff, I step away. I typically back off.
You go on vacation, is what you're saying.
I go on vacation. Yeah,
you go back on vacation. Yeah, but This is, you're exactly right. I mean, no one knows, no one has the crystal ball, right? I mean, I happen to think it's probably going to continue, that it's early on, because I think credit spreads are the next phase of this, what I call the main event. But it could also, I also recognize, the thing could just, get squashed here. Now, let's think through
can I add something on that actually? So with that note, if I go back through the history, and I'd have to go back through the history, but a lot of the times these spikes didn't correlate to the stock market bottom. So there was still more downside in the markets. And even if the volatility came off and started moving down, there was still periods. It basically sparked in some of these cases, the bear market. So
let's talk about game plans. Like, it's always about scenario analysis, right? So if volatility gets squashed, you do this. If volatility spikes, you do this from here, right? How do you think through sort of what are the different ways of either trading or positioning depending upon those two outcomes?
If volatility gets squashed, are you saying like how am I approaching this? Okay, yeah. So
scenario one squash, scenario two, it spikes further.
Yeah. Okay. So there's two things that I look at very simply, and that tells me when I can get a little bit more risk on. So I guess I can really talk about how I utilize technical analysis as a tool, right? So technical analysis, for those that don't know, it's not here to predict price movements. It's here to forecast potential moves. And there are some basic principles of technical analysis. One of which that to me is the most important is the markets, they alternate, markets, assets, whatever the case may be, they move between ranges of expansion and contraction. And at the current moment, when volatility rises, you're in a period of expansion and volatility. And you can go into various assets, and I look at thousands of charts every week. I go through my scans, I go through all this stuff. When the markets start to contract, you'll notice volatility come in, right? The length of these candles, they start to go in, they start to get a little bit smaller, and price action, it equals emotion. So during larger ranges, there's typically more emotion, there's more fear or more greed, right? It depends on which way you go. So I look for things to start to contract, to start to execute in. And there's times that there's two things that change as far as market conditions go that I look at specifically in the realm of swing trading. In the realm of swing trading, I look at two things. One, I like to look at that 5-day moving average from a 15-minute time frame. And it's small, it's very micro. A 5-day moving average is very small. This is something that I learned from the trader Brian Shannon from his original book. And it's not necessarily if price is above it or below it, it's the direction of it. So that's one aspect of it, just very small aspect of it. The second aspect of it is that gamma flip line. When we're in a negative gamma regime, what I like to look for is when we cross back above the flip line and start to break from that. So when that happens, this is when you have the dealers, they start to buy the dip, they start to sell the rip. Liquidity typically increases, volatility comes down. And that right there is my sign that I can starting to get more exposure back into the markets. When we start, on the flip side of that, when we're below a declining 5-day moving average and when we're in negative gamma territory, that is when my foot comes off the gas a little bit. And I'm totally fine with my portfolio flatlining to coming slightly down, taking a couple stabs here and there. I know I'm going to get chopped up. It's just part of the game.
I'm glad you mentioned that point about time frame, right? Which I think is interesting because there's an argument to be made that whatever your look back period is, let's say if you're in a low volatility regime, you want a longer moving average. If you're in a high volatility regime, you want a shorter moving average. Are you thinking through sort of dynamically tightening up that look back period? You mentioned 15-minute type, time frames. I have never myself done tests on that based on VIX levels, although I think it's an interesting concept. But what's your take on that?
So when it comes to as far as what the VIX does underneath the various certain moving averages, I think so. I don't put too much weight on it specifically. I know I talk about it frequently, but it's really just a directional thing because I'm looking at the markets of, okay, is it a safe area to get in here or what's the current trend? Because like I said, swing trading could be short term, up to 2 to 3 months. So I am looking very, very small, but the main aspect in all of those things, as far as the conditions of the market goes, is whether we're in that positive or negative. And we've been in the negative gamma regime now for a couple of weeks. That gave us insight. If you're thinking about I don't know a good analogy to use, but if you're walking the plank or something like that, and you're about to jump, like the flip line is jumping off the plank into the water. That's I heard that analogy, and I kind of like that, because you're about to enter into some rough waters, and until you get out of those rough waters, you can be on boat and stabilize a little bit.
There's a comment here from Techco490 I want to show on the screen. I think VIX exploded because they were suppressing it for so long. 2022 should have went way higher. By the way, I agree 100% on that. 2022 was one of the most bizarre years in the sequencing of stocks dropping alongside treasuries. Usually, it's supposed to be staircase up, elevator down, and it was actually a staircase down for both treasuries rates and stocks. This is the perfect storm of events to do it. I've written about this on the lead lag report side, this idea of that there could be another Volmageddon, where you get this like massive VIX spike, and we basically had that. But the idea of volatility suppression, I see that and hear that a lot. Any thoughts on that? If that's actually like a real thing, that there's since you mentioned gamma and dealers, is there just constantly selling of vol that just keeps it lower than it probably should be?
I mean, I wouldn't know to the extent of certainty, but I would imagine that would be the case, because that's exactly what it felt like. And then out of nowhere, yesterday, looking at that VIX spike, I'm pretty positive, right? That was the largest one-day spike in history, maybe, or close to it. And yeah, you'd have to think that there's something bigger that happened that we probably just don't know of yet. I can understand that, there's various narratives, but that felt like a straight somebody blowing up. So yeah, it was an unwind of being short vol, I guess. I really don't. That's what it felt like. Yeah.
I suspect a lot of big money has blown up in this. And it's even beyond what we just saw. When you had that massive small cap to large cap move that just happened out of nowhere, some of these spread traders, quant stat arb strategies, unequivocally went through like Six Sigma events. So, and they're very leveraged. Yeah. So there's we haven't heard about any of that stuff yet, but that's typically how it works. It's quiet, and then you hear about it months later. There's a comment here from Titus I want to pick your brain on, which I hadn't thought of this myself, but said, remember that volatility lives at the money, so you have to go deep in the money or trade the underlying equity. Sort of talk about that idea of volatility being at the money.
I don't really quite understand the question, really.
Well, I think in general the options traders love volatility because it affects the fleet, right? So maybe kind of expand on the option side. I'm sure you're tracking on the option side of things the last several days here, even though you just landed not too long ago. Any kind of interesting options movement that
let me tell you how I use options, because I don't personally trade options. I trade the equities, but I use options and I use implied vol in a huge aspect of what it is that I do. If you look at the options chain, if you go at the money, you can add both the ask of whatever the at the money put and call is, to give you an idea of what a potential expected move could be. These are things that I pull all the time. So you want me to share my screen? I could share with you what I do every single day. And let me just show you how absolutely crazy it's been these few days. And it's great. It's absolutely crazy. So let me go like this, and
and we'll try to narrate through for those that are listening.
Okay. Yeah. So this right here was sent out just yesterday. This is going into today's trading session. Can everyone see this, right? It's the expected moves. Yep. Okay, cool. So this right here is the expected moves just for the day, for the trading day. And this is something that I look at every day, and I can go into detail with it as far as I could go back because I have a history of all of this. And let me just show, this right here is a daily expected move. This is plus or minus, right? Plus or minus $10.20. I get my upper level, my lower level, and I even include 2 sigmas, because if you think of this in terms of a distribution curve, right? One standard deviation, it's going to be 68% of the time, it's going to finish within the upper level and lower level. 95% of the time, it's going to finish within the 2 sigma levels. And this is something that I'll look at a daily basis and even a weekly. I even bring it out to monthly and quarterly just to get a good idea. I could even show you kind of what that actually looks like. But yeah, so if I look at the SPY this is mind-boggling level. We're talking almost $100 expected move for the SPX, which is crazy. Now, IWM now has daily contracts or daily expirations. That's a $5 expected move for the IWM. These are wild, wild daily moves because most of the times weekly expected moves aren't even this big. So yeah, this is what I like to use, and I can give you more specifically in last night's brief. This was, okay, so this is the S&P 500. This is the SPY. And today, this is today's trading day, right? This is the range for today. And you can look at the VIX, right? That's the volatility index for the S&P 500 to get a roughly expected move, and or you can do what I just did there. So this would be the daily expected move that has a 68% range. Going out this far is the expected move for the VIX, which is a simple calculation. I posted it on Twitter if people want to see it. But you can see, is the market acting funky today? And the answer would be no. It's doing exactly what the market anticipated to do going into the close of yesterday, because 68% of the time, one standard deviation is going to close within this range. And knowing this, it allows you to have an idea of, hey, if I do go long, where would be an ideal place to potentially take some off, take partial profits, or if we start seeing massive move to the downside, where can that potentially be? So this is the 2 standard deviation range right here. So, you know, coming up here, you'd start hearing like 2 sigma type moves. A lot of people were calling for that face ripping rally. And I'm using today's example specifically because it's such a big day. But people have been calling for this face ripping rally. Moving within 1 standard deviation is not a face ripping rally. Going to 2 standard deviation plus, that is a face ripping rally. So hopefully that gives a little bit more insight to kind of how I use the options.
There's a good so we talked about options. There's a good comment here which I think is worth thinking through, because I know you do a lot of intermarket work as well. Thoughts on bonds catching fire if the media cycle starts spouting the great unwind and defense positions. Now, you've tracked me also for a while on this. I've talked about this. This has been one of those narratives that drove me crazy, this idea that bonds are no longer a safe haven. It's like people don't understand there's a difference between duration risk and credit risk. We went through a duration bear market. We have not seen how treasuries behave in a credit crisis, but just the last several days, clearly treasuries have been the safe haven, right? I mean, You're getting back to that risk on, risk off cycle, which I candidly need for my own punch in life. But what are your thoughts on looking at bonds, looking at treasuries, also from a signaling perspective? Because it's not really sexy to trade bonds unless you're trading very long duration treasuries.
So as a signaling perspective, I would say look into your work and actually read your white papers to understand how you can actually use that as a signaling process. For me personally, if I'm just looking at the technicals, they look primed to make a move. And honestly, it felt like the bond market knew it was coming ahead of time with all this stuff taking place in the first part. And I'll go back to I can go back to sharing the screen and kind of show you just a quick chart of, I'll use the TLT for example. But here, I'll pull that up really quick. So here's the TLT, right? From a technical charting perspective, let me clear this drawing set. Just from a technical charting perspective, what did you notice taking place early on? Well, you started to see price action put in a series of higher lows. You see the lower highs. This is just what I said. One of the basic principles of technical analysis is that markets, they alternate between range expansion and range contraction and range expansion. So you started to see things get very, very, very coiled up. And on top of that, if you're looking at trend analysis too, and you're just looking at the moving averages starting to converge and stack on one another, that's the 20, 50, 200, it looked like we were primed for a move. Whether that was to the upside or downside is kind of hard to tell. But like if you understand the signals and look into Michael's work, there was a probability that this stuff was all going to be caught in understanding that we could have a breakout in bonds. Now, is this going to lead to the next bull market? That would be the next question. Should I buy right here? That would be the next question. But what do I do as a trader? I don't really buy into the expansion. What I look for is price to calm down, price to start to contract again, maybe flag out, maybe for the averages to start to catch back up. And at that point, I can execute a trade, understanding where the risk levels might be. For example, if I went long over here, I'd have a stop here or a stop here, and I would approach it like so. Now, when it comes to bonds for a risk-off move, people were saying they're no longer a safety trade. I don't believe that at all. We just saw a huge flight to safety in a very short period of time.
You put out this really good correlation post around oil and the 10-year, which I want to show on the screen. And I think it's actually instructive of sort of the idea that oftentimes it's all largely the same trade, just under different tickers. So this chart looks at oil versus the 10-year. Yields tend to track oil, which makes sense because oil is a driver of cost push inflation. Yields are about inflation expectations being priced in. What's your take on the oil side here? Because I know you've been on vacation, but I'm sure you're seeing that oil looks confused as far as which direction it wants to go, especially given ongoing saber rattling between Iran and Israel and other geopolitical risks.
Yeah, oil, it does feel confusing. And like I said, with absolute certainty, I couldn't come with a direct answer. But from what I've noticed, and especially looking at this specific chart, is you can see oil somewhat leading the 10-year in the most cases, right? In most cases, you saw oil, for example, in April start to fall off. Shortly thereafter, the 10-year yield fell. And then there in June, we start to see oil rise. And then shortly thereafter, guess what happened? It's up until recently, it changed slightly where the 10-year yield fell right in July, and oil fell there shortly thereafter. What I can say from the aspect of oil is you pull up a very long-term chart. I don't have that chart in front of me right now, but if you look at the rate of change, you can go back through history, and any huge move in the rate of change of oil has led to problems in the U.S. economy and around the world for the most part, dating back to the embargo. And even recently with the huge spike in oil, going back, I think it was 2021 or 2022. I can't remember the exact time frame, but we did go into that 2022 bear market.
Have you ever traded the inverse ETFs, or do you just stay away from those?
I do. Yeah, I'll trade them every once in a while. But so to understand kind of how I approach that, it's very important to understand that my position sizing when I go short is significantly different from my position sizing when I go long.
Yeah.
And I typically, so when I post like some trades and stuff like that, I almost never post short positions. I'll share my most recent short position. I will do that. I have a chart to show kind of where that came from. And I did use an inverse ETF, but I want to be very clear here. If I take up to a 10% position in an equity from a long perspective, my short positions are like 5%. That would be the max. You see, so it's going to be cut in half. And it'd probably be even short because a lot of these inverse ETFs are like 3x. So it'll allow me to have a little capital in. But
yeah, and so I asked that because there's a good comment from Raul here. I want to show is asking the question: why don't you guys just hold SQQQ if we haven't hit a bottom yet? And this is what's missed by a lot of people that trade these inverse funds. Aside from the sizing aspect, it's hard. I get it. It's hard for people to conceptualize how the path factors into the leveraging on an inverse side, right? I mean, there have been plenty of examples where markets end up being lower, but the inverse funds end up losing money because the volatility in between the buy and the sell is so high that it just throws off the compounding effect.
Yeah, if you're holding these long term, you got to really understand what it is that you're actually buying. I use those as like a trading vehicle, but I'm not. If those aren't like long-term hold sort of ordeals, because you have to really understand what the product is and what they're doing, behind it. I remember in 2021 when all this stuff was going on, everyone's like, you could have just held TQQQ and all this stuff, and it's like, well, yeah, for a period of time, but you got to understand what happens when things start to turn around. What's the decay look like, and so forth. But yeah, I'm okay with the inverse funds or the leverage funds, but I look at them through the lens of a trader, a shorter term trader.
So I give you a lot of credit because you're not originally from the industry. You self-educated. You've got a lot of people that are looking to you as a trader and looking for ideas. When people are watching your videos and your content, what's sort of your primary objective from an educational perspective? Is it that you're trying to give ideas or insights into things that you're observing, or is it more that you're trying to teach somebody how to fish, so to speak?
The main thing that I do is I try to teach people how to fish. So a lot of the problems that I get or run into with various, you can call them trolls, you can just call them whatever you want. The common thing is, so it can go up or down. And the answer is, yeah, it can go up or down. But understanding, like I said, just the other day, right? People are saying they're calling for a face ripping rally. I'm like, okay, but what if you're wrong? So you need to understand, okay, where can it go? What if you're wrong, and so forth. So I always focus on the risk aspect of things. Even in the Discord and everything, it's the same thing. I'll post a trade idea, but it's just something that I'm looking at. It's not an alert. It's nothing like that. You got to learn how to manage risk, and you need to learn what works for you. Everyone's different, right? And that's the most important part to understand is you can go find somebody that got 9 out of 10 trades correct. So the next trade that they post, you'd be like, I'm going all in because this guy hits them all. And you leverage it up too much, or it's too big of a position, and it takes one trade to wax you out. Whereas I'm kind of in the boat where like, I just need 4 trades to work out of 10. And if I get 6 out of 10, I'm looking really good.
Okay, so that statement right there tells me you are a pro in reality and not a BS artist, because that's so missed by a lot of people. They think you have to get every trade right. And I always go back to this idea that 4 out of 10 is phenomenal, actually, as long as they're home run type of trades, right? It's like too often people confuse frequency with magnitude. It's okay to be wrong a lot as long as when you're right, you crush it.
Absolutely. I mean, I would take 19 small losses and 1 monster win and hold on to that winner. And I would take that any day of the week, because I know for a fact if I just chopped it, look at the Tesla trade. The Tesla trade in recent move was just like that thing. That was probably the most obvious looking trade of a big move to come. And the reason why I say that is because, if I were to pull that up, Tesla's been down all year. Okay. And no, I didn't say on the first bounce or the second bounce up off the news. So it was earnings, it was up. Then there was some other news, it came up. No, it was beyond that. Once it started going sideways and really starting to get tight, it was right underneath that year to date anchored volume weighted average price, which is a pretty big psychological level for the most part. And the moment we started crossing through that, the risk was so small. So if I was wrong, okay, I get stopped out. Big deal, right? Tiny little loss. But the move exploded to the upside. And it's like, okay, like, am I going to sit here and be like, honk horns and be like, yeah, I got that right. It is such a big move. No, because you can take I could have taken 12 cuts, 12 small losses, and that thing would have just made up for it and some. So, yeah.
I'm glad you mentioned stops. I think that's also kind of an interesting area to focus on, because stops are also a function of volatility. So when volatility explodes, it becomes really problematic. Do you do stops and just put them actually in the market, or is it more just levels that you're just saying, hey, I have to sell at this point?
Yeah. No, I'll use stops. I like to use stops, especially if I'm not going to be around the computer. If I'm around the computer, I'm okay with just having the mental stop if it's really coming down into that area. But I have typically around a 6 to 8% rule, and that's typically could be up to a 6 to 10% size position. So it's not like it's crazy huge. I'd be paying a lot more attention if I had a lot more, exposure in the markets. But when I put something on, it's not to the point where I'm like biting my fingernails out of the gate. Like, I'm okay. Right. If it actually fell 8% when I put it on like this, which it kind of did in this volatility, I'd be just stopped down, or I just hit out. And sometimes if I really don't even like how it closes on the day, I might just get out right away and just wait to see how it shapes up the next day. And if it starts to see strength, we start to see what I like to personally look for, right? Various things on breakouts, then we'll go for it. But I already know to back off a little bit when we're in this negative gamma regime, when we're in a trending down environment.
Okay, so again, let's expand on that, because we talked briefly about game plans with higher volatility, game plans with lower volatility. What about game plans with recessions? So there's a comment here from Triple J, not Double J Jeff Jarrett from wrestling. In the case that we do slip into recession and the consumers default with buy now, pay later. By the way, I've been talking about that actually as a risk. Okay. So I'm glad you mentioned that. Would you short banks or fintech, specifically fintech ETFs? So I think we haven't seen in a while a in quotes traditional recession, right? Mm-hmm. I mean, realistically, right? It's always been almost more panicky, event driven. It's momentary. They flood the system with a lot of money, and then it's right back to the races. Which means a lot of traders don't really know what it's like to go through a prolonged contraction. So let's talk about that let's say we actually do hit a recession, the unemployment rate is rising, and it's not going to be a recession that's like, short. It would be, more of a longer lasting 9-12 months. What do you do in that situation as a trader?
Yeah, so I approach the markets just kind of how I've been saying, right? I understand that in recessions it can bring on more volatility, and I'll know if the volatility is going to be there because I'm looking specifically at the gamma levels and the gamma flip line. When we're below that, or if we're below declining 5-day moving average, and during this periods in recessions or bear markets more specifically, because you can see huge moves to the upside. That's very common to see. Just look at the Nikkei, right? How that thing just fell down super hard, like a historic 3-day move, basically. And it goes up 8%, which is just an inside trading day, 10%, whatever. And people are like, everything's fixed. It's during recessions. I'm just going to share. I'll share the chart. People are saying my screen froze, but I don't know if that's true or not. But
yeah, I think for when you share the screen, either you're hyper focused or it freezes. But yeah, exactly. But you're fine. We can hear you.
Okay. I'll share this window here, and I'll show you what I mean by like bear markets or recessions, right? So for example, like here is 2000. This is the dot-com bust. This is the financial crisis. This is the 2022 bear market. This right here is just a 1-day rate of change, and it's very simple. So what is the rate of change? It tells us for 1 day. It tells us where did we close for the day? Minus, down below the zero line is a negative day, above it is a positive. And what do you notice here in times of higher volatility or recessionary times? What you'll notice here is you get much more significant moves to the downside, followed by significant moves to the upside. You can literally see it kind of growing out like so, right? So,
which by the way, just not to interrupt it, that's exactly why I believe, and I keep saying shorting is so tricky, because that's the volatility clustering. Extreme downs tend to be followed by extreme ups.
I think shorting is probably the hardest thing you can do in the markets.
Amen.
And that's the thing, is because if you're most typically when it comes to shorting, people start talking about on their first down move, and it's already aggressive, right? Because the markets take their stairs up when volatility is compressed, and then it takes an elevator down. And yeah, I get it. People have been saying it's been taking the elevator up. Well, now that's actually quite not the case after we just saw these last 3 days where we had a rate of change of minus 3%. And we haven't seen that since the original bear market. So to see a 2% up day in the near future with, the VIX at 38, which would equal an implied move of roughly 2.4%, that would be very common, right? Very common to see that type of stuff. So in recessionary times, which you're mentioning a recession, I don't want to hold a short position through a 6% move to the upside or 10% swing to the upside and try to catch it. I'd rather just be on a beach chilling with my portfolio going sideways. I feel a lot more calm, a lot more comfortable. And if I find a very, very extended move that makes sense to fade for a very short period of time, I'll approach it. And like I said, I can share with you, sorry, let me go back to this screen. I can share with you the exact short that I did from a correlated standpoint, from an intermarket standpoint, and how I approached that. And it was, it played out in my favor, but it was, in a way lucky. If you want me to share, I can.
Yeah, please.
Okay. So people would ask about the inverse funds and so forth. So let me see where is it? Okay, yeah, there it is. The short position that I took, and this is probably the only one that I shared all year, and it's not even that big of one, to be quite honest. It was somewhat of a short, small position, but per usual. So this right here is a chart of silver and a chart of the miners. And I kid you not, everybody was bullish miners not too long ago, right? And they probably still are. Things were looking really good. I mean, you get these consolidations, a massive breakout, but understanding correlations is pretty interesting business, right? So what I've noticed is silver correlates incredibly well, very positive, right? If we're looking at a 20-day correlation to the GDX, so that's just miners, right? And from a historic standpoint, you can look like, man, we're literally in positive correlation pretty much all the time. And there's various times that you can see that silver was actually putting in lower highs, but the miners kind of kept going, probably because it's an equity, right? It's not like silver, which is, more of a commodity and so forth. But seeing this, I was like, wow, miners are really cranking right here. And silver's actually kind of coming off. It didn't make a new high. And right in this area with a pretty strong positive correlation, actually at the time, it was like 0.75. This right here was insight to me. I was like, yeah, this seems like something that I would potentially put a fade trade on. That would be obviously correctly positioned. And I use DUST, which is, you know, a 3x, just inverse miners or whatever. And, you know, we saw a little move up. I held into it. We had our first initial reaction to the downside right about here, where I exited about 50% of the position. And then I tried to close it early morning on this day, just on this last volatility, another 50%, but I couldn't get into my brokerage account. There's a lot of problems, and I closed a little bit mid higher. So I still have a little bit on, but you know, that's a 24% gain in a very short period of time. Mind you, it's 24%. It sounds like a lot, but my position sizing was smaller given it was a short and 3x. But that is, you know, one of the short trades as a fade into an expansionary move that I looked at.
Got a fan of yours is asking the question, hey, Mike, have you moved away from very short-term day trading in favor of swing multi-day trading?
I'm still, my main priority is swing trading. I will go into day trading on a case-by-case basis, but it's not my favorite. I think that there's a lot of opportunity there. I think there's a lot of opportunity there if you have the discipline to walk away when you actually make a trade, or if you have very strict process and rules in place. And if you can manage that, all the better. There's very specific tools that I use for when I am. I want to make sure the video is still up here. I'm getting some errors, but my main priority is swing trading.
Do you find that, because I still see this on X quite a bit, just everyone talk about day trading. I've looked at the studies around this. I've done back tests. I don't think there really is such a thing as a truly successful day trader. I mean, yeah, you can maybe scalp here and there, but the reality is it's not really where most of the returns come from. I mean, where does that misconception come from that day trading is the way to generate returns? I mean, all the evidence says it's largely the exact opposite.
I mean, it's probably the same feeling people get that if they think that they enter into the World Series of Poker, they have a chance of winning first place, right? You're not going to win first place. It's incredibly difficult. You need some luck, and you need to be incredibly patient and intelligent, right? There are going to be, you know, if you look at it as a distribution curve, there'll be deviations out where you do have day traders that are incredibly successful at what they do professionally at a professional level, where I doubt that they even call themselves day traders. They probably call themselves just like money managers or risk managers at that point. And they, you know, they say, what's the stat? 95% of people fail. And what's even more interesting from a book that I read or listened to, it's called, man, I forget the name of it. Unfortunately, it's by Tom Hugard. It was an incredible book, but they went into the CFD sites, right? That do this, and they looked actually at what they have to post, and they say, yeah, 80-90% of the people here fail, but most of them have more winning trades than losing trades. So even the biggest losers that are like, they win a bunch of times, which gives them that ego boost. But typically what happens is they'll win a little bit. They'll try to go a little bit bigger, a little bit too fast. And it takes one trade going against them, and they just don't know how to adapt and walk away. So yeah, day trading, it is an incredibly difficult task. And I would recommend going into swing trading and or even investing at that point if you're just getting sloshed around.
Yeah, I mean, certainly a lot less random and noisy, right? Which I think is key.
And I'll add to that too. So a lot of times how it's positioned to us, how day trade is positioned, man on beach, man with Lamborghini, man, oh my gosh, look at me, alpha, right? I'm gonna tell you what my day trade looks like, right? I'm not taking crazy swings when I day trade. I'm looking to make like grocery money, right? I'm like, if I make a few $100 here, a few $100 there, or I could pay my mortgage in the month or whatever the case may be, I'm not trying to have a $20,000 hit day. If it happens, cool, dude, awesome. But that's not the case here. It's literally just, I'm trying to pick up some change if I day trade and just have a little bit of extra cash, go on a vacation, buy something, actually take the money out, make sure it's real.
final question, then we'll wrap up here. This is a good chart. You showed S&P 500 election year seasonality.
Yeah.
Seasonality is always interesting to me. I mean, there's a lot of evidence that suggests that it does work. I mean, more often than not. But I wonder from a trading perspective, are you paying attention to seasonality at all? Does it make you think differently about position sizing, anything like that?
Not necessarily position sizing. I like to look at the pivots that if, for example, coming into July, it looks like there's on election years, you could have a pivot to the upside, but I wanted to dig a little bit deeper into that and look at the prior election years. So I pulled up just like every, whether there's so many charts in that thread, but like the Democratic years, the Republican election years, and try to see if there's any correlations there. And the end result in all of that was there was no correlation to what can potentially pan out here in the very near future. There wasn't clarity. So yeah, when I saw that, it's just like, yeah, you typically see a bump up, which we saw one day bump up, but then it got faded really hard. So yeah, I'll look at potential areas for pivots on main seasonal points, but it'll be in my back of my head, but I don't actually structure a trade specifically from that.
What would you say is the most important rudimentary law or rule of law or rule in general that traders have to abide by? That it's a non-negotiable thing if you're going to be a trader.
Control what you can control. That is it. But people are about, well, what is it that you can control? There's 4 things, right? So there's 4 things that you have complete control of. I won't show the deck, but okay. So the 4 things that you could potentially buy, or the 4 things that you can control, I want you to pay close attention, because outside of this, you're going to realize there's probably something that you're paying most attention to, which you have no control of. So that's what you buy. Okay. Specifically, like what asset, into what market, whatever the case may be. So what you buy, how much of it you buy it, right? So you're thinking position sizing. Okay. That you can control. When you buy it, timing, what tools can you use, right? That you can control when you buy it, not when you sit down at the computer and like, I gotta buy, right? No, you gotta be patient, right? And make sure it's the right setup. And then when you sell it. So when you sell the product is incredibly important, right? It's the second trade. Every trade that you make, there's going to be a second trade. So you might as well control what that second trade is gonna look like, whether that's gonna be from profit taking, from stopping out, whatever the case may be. So once again, what to buy, how much to buy, when to buy it, and then when to sell it. Notice that what you can't control is your win rate. You can't control that. You can only control your losses. That's it, right? You don't know how high something's going to go. You don't got that control, all right? So from what I've noticed throughout history and what I typically see here, when you see the 95% losing traders and you see that they're typically win more than they lose and they're still losing traders, what you'll notice here is, and you can go back through your history of if you're day trading or swing trading, and if you're struggling, if you just take out your 5 worst trades for the year, 5 worst or 3 worst, what is your P&L going to look like? If it goes from, hey, I was minus 20%, but if I took out my 3 worst trades and I'm positive 10%, you know what the problem is. Your problem is having to reduce that, whatever those losses, right? Controlling that.
Mike, for those who want to track more of your work, I know you're primarily focused on the YouTube channel, but talk about subscribing to that and anywhere else that people can find you. Yeah,
so I'm on X at Mike P. Silva. You can follow me on Twitter. I have the YouTube. It's Figuring Out Money. You can just Google that or go to the channel. And then if you want some more exclusive content, I do have a Patreon. I don't charge on an arm and a leg. It's $9 a month, but I do give a lot of stuff in there. I have a premium bot service through TradeETX there with the query channel. It's not an alert service. Don't come in there thinking that it's an alert service. It's a tight-knit community. We just try to better ourselves and do what we can do there.
The good thing about this conversation is that Mike was very eloquent, and we're both named Mike, of course. Everybody, please make sure you follow Mike Silva. I'm going to do another one of these live interviews literally in 10 minutes with Lynn Alden, so stay tuned for that. And
hey,
Mike,
by the way, thanks for putting me before her. Okay,
what?
she's a rock star, man.
You're both rock stars. You know, listen, as long as you're a hard worker, you're a rock star. That's how. That's what defines rock star to me. Appreciate those that watch this live, and hopefully I'll see you on the next episode of Lead Lag Live. Thanks, Mike.
Thanks.